$400 million. I mean, let that number sink in for a second. That is the size of the newly authorized share repurchase program just announced by Freshworks. Welcome to The Explainer. Today, we're diving deep into the strategic transformation of Freshworks, ticker symbol FRSH. Look, after hitting full-year GAAP profitability and pumping out over $223 million in free cash flow, which, by the way, is nearly triple what they did in 2023, this management team is sending a massive, flashing, neon sign to the market.
Throughout this explainer, we're going to unpack exactly how that incredible cash generation is transforming directly into major shareholder rewards. Because it's not just a buyback, right? At the recent Refresh 2026 analyst session, Freshworks completely accelerated their timeline. They're scooping up their own stock while simultaneously raising their long-term financial targets for 2028. It's a textbook example of a company intentionally pivoting its core business to chase higher growth. And we're going to break down the exact mechanics of how they're actually pulling it off.
All right, so here is our roadmap for today. We'll start with a tale of two segments. Then we'll explore the EX and AI engine. Next up is unifying sales and strategy, followed by rewarding the shareholders, and finally, we'll tie the whole thing together in the road to 2028.
Section 1. A tale of two segments. To really grasp what Freshworks is doing right now, we have to face their current reality. They're basically running two totally different businesses under the exact same roof. On one hand, you have the employee experience, or EX segment. This thing is an absolute rocket ship, growing at a blistering 27% year over year, hitting over $540 million in annual recurring revenue. But then, on the other hand, you have their legacy customer experience, or CX segment. It's sitting at over $395 million, but it's barely crawling along at just 6% growth. Management isn't hiding from this, though. They're explicitly pivoting. They're putting CX in the slow lane to manage for efficiency, while pouring the gas on the hypergrowth EX side.
So what's actually driving that massive EX growth? Well, it's their push-up market into what they like to call agile enterprises. Freshworks now boasts 1,646 customers dropping over $100,000 annually. That is a massive 29% jump year over year. They aren't just the small business software guys anymore. They are systematically going in and knocking out legacy systems in head-to-head battles. To put that into perspective, in Q1 2026, they locked in the two biggest deals in the entire history of the company, including their very first contract worth over $1 million in ARR. Game changer, right?
Which leads us to Section 2, the EX and AI engine.
Okay, so how exactly are they landing these monster enterprise deals? Two words: Freddy AI. For new deals over 30 grand, the attach rate for their Freddy AI Copilot is running above 65%. Let that sink in. Overall AI penetration in the EX segment just blew past 20%, which is nearly double what it was last year. AI isn't just some shiny marketing toy for them. It is a highly effective commercial wedge to pry open those massive enterprise budgets. And because of that success, Freshworks is literally changing how they make money, shifting away from the old pay-per-user model to a hybrid one that's actually tied to AI-driven resolutions.
And the absolute core of this new pricing strategy is something called agentic AI. Imagine having an autonomous digital employee seamlessly living right inside your workflow, like in Freshservice. With tools like their new AI Agent Studio, you can stand up custom HR and IT agents with literally zero coding. Because these AI agents actually deflect support tickets, track your infrastructure, and massively boost human productivity, they deliver hard, measurable business outcomes. And that makes justifying those huge, six-figure enterprise contracts a whole lot easier for the buyer.
When you fast forward this momentum, the end game of this whole strategy becomes incredibly obvious. By the time we hit 2028, Freshworks expects employee experience to make up roughly 70% of their total ending ARR, leaving CX and the rest to fill in that remaining 30%. They're done pretending to be a perfectly balanced portfolio. They are looking the market dead in the eye and saying, "We are an EX-first company."
Moving on to Section 3, unifying sales and strategy.
You know, you can't just completely rewire your product focus without rewiring the actual company, too. To build a legitimate, heavy-hitting enterprise sales machine, CEO Dennis Woodside did something bold. He unified their entire global sales, customer success, and customer experience teams under a single leader, Chief Revenue Officer Ian Tickle. By putting all their go-to-market muscle under one highly experienced CRO, they are hyper-optimizing their teams to hunt down those massive, upmarket EX expansions.
All right, Section 4, rewarding the shareholders.
Now we're getting to the stuff investors absolutely love to see, the financial discipline that comes from making these hard strategic choices.
Because look, when you focus your product line and trim the fat, you generate serious cash. Management basically executed a 3-step playbook to radically improve capital efficiency. Step 1, an 11% headcount reduction, which was largely made possible by their own AI productivity gains. Step 2, aggressively slashing stock-based compensation. And Step 3, taking all that cash they just freed up and handing it right back to investors through that massive $400 million share buyback authorization.
Now, what's really fascinating here is the sheer scale of the drop in stock-based compensation, or SBC. If you follow tech stocks, you know that bloated SBC is public enemy number one because it just constantly dilutes your shares. Back in 2024, Freshworks SBC was chewing up a staggering 30% of their revenue. But by tightening up who gets stock, lapping their old IPO grants, and just focusing on raw efficiency, they project that number to plummet to 16% in 2026. And by 2028, they're targeting an incredibly lean 13 to 14%. For shareholders, that is a monumental win.
And honestly, it's that exact financial discipline that gave CEO Dennis Woodside the green light to authorize the buybacks in the first place. His quote really says it all. This follow-on share repurchase program demonstrates our confidence in the company's long-term strategy, durable growth, and dedication to disciplined capital allocation. Hitting GAAP profitability in 2025 was the proof of concept. The board clearly believes Wall Street is undervaluing their shares right now, and they finally have the cash hoard to confidently buy back their own stock without starving their future growth.
Finally, Section 5, the road to 2028.
Everything we've just talked about, the big pivot to EX, the genius AI monetization, the unified sales structure, the strict capital efficiency, it's all been building up to this very moment. Because of how well this is working, Freshworks just completely raised the bar. Their 2028 revenue target jumped to over $1.3 billion. Their free cash flow target skyrocketed over $425 million. And their non-GAAP operating margin, they expanded that by a massive 400 basis points, bumping the target up to between 24 and 26%.
So when you take that rapidly expanding free cash flow and you mix it with a shrinking share count from the buybacks, you end up with an incredibly powerful compounding machine for individual shareholders. Think about it. Adjusted free cash flow per share was just 50 cents back in 2024. Now it's estimated to hit 94 cents this year in 2026 and is projected to climb all the way to $1.35 per share by 2028. We are literally talking about a 28% compound annual growth rate. That is massive.
But as we all know, in the stock market, execution is literally everything. Freshworks hasn't just raised their guidance, they've raised their ambition from hitting the Rule of 45 to the elite Rule of 50 by 2028, meaning their revenue growth rate plus their free cash flow margin needs to equal 50 or higher. So here is the million-dollar question for you. Can Freshworks successfully scale this huge upmarket momentum and their AI monetization while simultaneously keeping that legacy CX segment stable enough so it doesn't drag down the entire valuation? That right there is the definitive question every single investor needs to be watching in the upcoming earnings reports. Thanks so much for joining us on this explainer, and we will catch you next time.